All right, today we are getting into a serious quantitative deep dive on the future of the oil and gas industry. We're going to be using the IEA's big analysis as our roadmap here. And look, this isn't about opinions or politics. This is about the cold, hard engineering and financial numbers that the industry is facing as the world transitions. So let's get right into it. To really get our heads around the scale of what we're talking about, let's just start with this number, $3.5 trillion. That was the average revenue per year for the global oil and gas industry just between 2018 and 2022. It's a number so big it's hard to grasp, and it shows you the incredible economic and political power we're dealing with on a global stage. And that immense scale, that financial gravity, it all leads to the single most important strategic question of our time. I mean, if your entire business is built on hydrocarbons, what on earth is your role, your future, in a world that's trying to get to net zero? The answer isn't simple. In fact, it's not one answer at all. It really depends on the path we all choose to take. So, here's how we're going to break this all down. First, we'll look at 3 totally different futures the industry might face. Then, we'll dive into the engineering nitty-gritty. What can actually be done to decarbonize operations? After that, we'll explore some new technology pathways. And finally, we'll tie it all together and look at the investment risks and the financial realities of it all. Okay, let's start with those 3 potential futures. You see, the IEA doesn't just guess. They build these incredibly detailed models, these scenarios, and each one is based on different assumptions about what governments will actually do. You really have to get these 3 paths. So first, you've got steps. Think of this as the business as usual path. It's based only on policies that are actually law today. That path gets us to about 2.4 degrees of warming. Then there's APS. This one assumes every government actually does what it promised to do. A big assumption, right? That gets us down to 1.7 degrees. And finally, NZEA, net zero. This is the moonshot. It's the narrow, incredibly tough path to hit that 1.5 degree target. And here is where the rubber really meets the road. Look how those policy choices smash into oil demand. I mean, the difference is just staggering. In the STEPS world, demand is pretty strong, right around 100 million barrels a day. But in the NZE world, demand absolutely craters. It falls by 75%. That gap between, say, 97 and 24 million barrels a day, that's not just a gap. It's an existential crisis for the entire business model. And it's the same story for natural gas. What's kind of shocking here is that even in the most optimistic scenario for the industry, STEPS, demand basically flatlines and starts to fall after 2030. And in the NZE scenario, it's a collapse, down to less than a quarter of what we use today. So that whole narrative of natural gas being the indefinite bridge fuel, well, this data really puts a clock on that bridge. So of course, this cascades right downstream. If demand for fuel plummets, refinery runs just fall off a cliff. Look at the NZE pathway. Refinery throughput absolutely collapses. We're talking about a world with massive overcapacity. This isn't just a headache for refiners, it's a huge stranded asset risk, and it has major ripple effects for petrochemicals and for entire regional economies built around these massive industrial sites. Okay, so while those big picture demand scenarios are playing out, there's a totally separate and much more immediate pressure on the industry, cleaning up its own house. And that brings us to our next section, the real engineering challenge of tackling Scope 1 and 2 emissions from your own operations. To solve a problem, you have to know where it's coming from. And this breakdown is crystal clear. Look at that. A whopping 55% of all operational emissions come from methane leaks, venting, and flaring. That is the low-hanging fruit. It is the single biggest, most obvious target for immediate action. And just how big of a target is it? Well, get this. The IEA calculates that over 75% of the methane emissions happening right now could be avoided with technologies that already exist. We have the tools today. And what's more, they figure about 40% of those cuts could be done at no net cost, simply because you capture the gas and sell it. It's not a cost, it's a revenue opportunity. So here's the engineering toolkit and the price tag that goes with it. To get emissions intensity down by more than half by 2030, which is what the NZE scenario calls for, you're looking at a total investment of around $600 billion. Now, tackling methane and flaring does most of the heavy lifting, about 70% of the work. But there's also serious capital needed for things like electrifying facilities and slapping carbon capture units onto big, concentrated sources like LNG plants. Okay, so cleaning up your current business is one thing. But what about growth? Where are the new opportunities? Well, this next section is all about how the industry's incredible engineering know-how, its project management muscle, and its access to capital could be pivoted into the energy systems of the future. So you hear this idea a lot. Let's just repurpose all our LNG terminals for liquid hydrogen. It sounds great, but from an engineering perspective, whoa, it is a huge challenge. Hydrogen has to be cryogenically cooled to minus 253 Celsius. That's almost 100 degrees colder than LNG. The process itself eats up to 30% of the energy in the fuel, and you'd likely have to rip out and replace all the critical pumps and valves. It's not a simple retrofit. It's a major re-engineering project. Now let's talk about the big one, carbon capture, or CCUS. The IEA is very clear here. It is an essential tool for things like cement and steel. But, and this is a huge but, it is not a panacea. The numbers to make it a cure-all are they're impossible. To offset business-as-usual fossil fuel use would cost more than the industry's entire revenue today, and it would use more electricity than the entire world used in 2022. The bottom line? It's a scalpel for specific problems, not a get-out-of-jail-free card for the whole industry. So if CCUS isn't the magic bullet for everything, what about a massive hydrogen build-out? Well, here's where the demand is actually projected to be. And the vast majority you can see is in heavy industry. We're talking steel, chemicals, ammonia. And then another big chunk is in long-haul transport, like shipping. This is the real target market for big, ambitious hydrogen projects. And we can't forget about bioenergy. This is a pathway that requires a 6-fold increase in investment just by 2030 to keep up with the NZE scenario. And honestly, this is right in the industry's wheelhouse. It's all about refining, logistics, complex chemical processing, skills the industry has been perfecting for a century to make things like sustainable aviation fuel. Okay, we've talked about the operations, we've talked about new tech. Now it's time to get to the bottom line and translate all of this into the language that really matters in the boardroom, finance. Let's talk about the investment risks and the cold, hard calculus of these 3 different futures. Let's just start with this number, because it says so much. Negative 60%. According to the IEA's financial models, that is the potential hit to the total valuation of private oil and gas companies if the world actually gets on that 1.5-degree path. It is the price tag of transition risk quantified. And really, this quote from the report just says it all. As the transition speeds up, the fundamental risk-reward equation of this business changes. You're looking at a future with lower prices, lower volumes, and a much higher chance that your multi-billion-dollar assets become stranded. The game itself is changing. So if you're an executive, what do you do? Well, this chart shows the kind of radical shift in capital that's required. To align with a net zero world, a major oil company would need to flip its spending completely. By 2050, 90 cents of every dollar of capital would go into clean energy, leaving just 10 cents for the legacy business. It's a total transformation from an oil company into an energy company. And let's get really specific on that stranded asset risk. The NZE scenario is blunt. No new long lead time projects are needed, period. So think about those massive deep water exploration projects that take a decade to develop. That means all the capital already sunk looking for those fields, an estimated $400 billion, could just get written off without ever producing a drop. So as we wrap up, I think the most important thing to realize is that there is no single path forward here. We're going to see a huge divergence. Different companies, especially the national oil companies versus the international ones, are all going to pursue wildly different strategies. It's not going to be one industry moving in lockstep. And that really leaves us with this final massive question for the future. As all these incredibly powerful players start pulling in different directions, you've got some doubling down on hydrocarbons, others pivoting as fast as they can to clean energy. How does that fundamentally re-engineer the entire global energy map? We're talking about the physical, the financial, and the geopolitical landscape. That is the multi-trillion-dollar question that's going to define the next few decades.